This is a talk on financial planning conducted by the Financial Services Consumer Association. The topic is life insurance and structured products. Life insurance policies combine savings and protection. For example, whole life policy, endowment policy, and investment-linked policy. You pay a regular premium, a part of it goes to provide protection, and the rest is kept as savings. Now, some agents will tell you the benefits of a life insurance policy, but they do not tell you about the cost. So consumers may end up paying too much and get very little, too little in return. Before you buy a life insurance policy, do ask for the benefit illustration and ask the agent to show you these figures. First, the distribution cost. This is shown in the benefit illustration. It is the amount taken out of your savings to pay commission to the insurance agent and other marketing expenses. Make sure that the distribution cost is not excessive and is the amount that you are willing to pay. This is the amount that is taken away from you. Look at the cash value of the policy after 25 years. Compare this with the annual premium and calculate the yield based on the cash value and the premium that you pay. What is the yield you are getting for that 25 years? Now, for the life insurance policy to be attractive, you must have a yield of at least 4% per annum. If it is less than 4%, then it is not attractive as a form of investment. Most life insurance policies give a yield of 2 to 3% per annum over a period of 25 years or longer. Now, this yield is too low. For example, take a look at a monthly savings of $500 over 35 years. If you get a yield of 5%, you should be getting $542,000. But if the yield is only 2%, you are getting $300,000. So $300,000 is too low. $542,000 is quite attractive. Now, just by getting a lower yield, you could be losing up to 45% of the amount that you should be getting. Now, how do you calculate the yield? You use an Excel, and the formula that you use is called rate, and you enter the number of years, the annual payment, and the amount that you're getting at the end of the period, and this will allow you to calculate the yield, which in this case is 3.1%. Now, there are also, I'm now going to talk about structured products. These are investment products created by some banks and sold to consumers through another bank. These products are very well marketed, so you see them advertised in the newspapers or in posters at the branches of the bank. Now, every product is different, so it's very difficult to explain the features of any specific product, and in most cases consumers do not fully understand the features of the product. But for those who understand, they know that most of these products do not give good value, they do not give a good yield to consumers. Now, one category of products are called guaranteed products. They are capital guaranteed. At the end of the period, usually 5 years, you are assured that you will get back your principal with no investment loss. Now these include capital protected and capital guaranteed products. Now what consumers do not know is that these products have high charges which are not transparent, and they offer a poor return, a low return to investors for the period that the money has been invested. There's another category of products called the linked products. They can be equity linked, credit linked, currency linked. All of these products have high risk, but these risks are not explained to consumers, and as a result many consumers suffered large losses on these products due to unexpected events. In good times, the return is actually quite modest. It's not worth the risk that investors have to bear. You should also avoid speculative funds. These are investment funds created. They are what I call the flavor of the month fund. At any point of time, if there is certain type of investments that look quite attractive, the fund managers will create funds to invest in these assets, but in most cases the prices have gone up too high, so these funds based on the high price of the investments do not produce attractive yield. Furthermore, the fund manager take away very high charges which are not explained. Often these funds are not well diversified, and generally they give a poor return, a disappointing return. Another category are even worse. These are products that are not regulated by the government, so you have to be careful before investing in these unregulated products. Some of these investments are actually scams created to cheat the investors. Now some of these products produce a high return. Well, they promise high return, but they are usually not guaranteed. They're usually not delivered, so you don't get the return that was promised. So do not be greedy, do not invest in these products. Some of these products are land banking products, Ponzi schemes, wine, oil port, guaranteed buyback schemes. There are many types of investments under this category. This is the end of the topic.